Good evening, Paul D'Souza from Sightline Wealth Management, and I'm speaking with Warren Giroux, Senior Investment Consultant to Sightline, as well as pension funds and high net worth families. It's the evening of March 25th. So, Warren, we've had 2 up days now. What are your thoughts on that?
Well, it could be a bit of a dead cat bounce or a reflexive rally after some major down days. Certainly, at the current valuations, there are people who are considering that some of their best idea stocks are looking very attractive, and we find that they're nibbling. I think based on the volume, we're not seeing strong volumes on these up days, but we're seeing that there are some buyers coming in, which is encouraging news.
Right. So we've seen year-to-date in 54 days, relatively flat until February 19th. And then the last 2 weeks has been just absolutely brutal on the downside, going down as far as 36-37%, and then about 10 to 15% rally. So I'm with you in terms of I'm not 100% buying this rebound. I think it's largely in response to the stimulus packages, the aid packages from the United States and Canada. I know in the U.S. it's not quite yet passed, and I think Bernie Sanders had something to do with that, didn't he?
Yeah, what was sort of certainly was encouraging yesterday. At one point, the market was up over 1,100 points, and then late in the afternoon, it came out that Bernie was considering holding up the package because there was a couple conditions in there that he wasn't quite happy with. But I think that'll be worked out. The market fell off as a result of that to being only up about 400 points. But I think that'll be worked out at some point, and they have to get this aid package through, and I think it will be done. And then it's supposed to go to the House. I think on Wednesday or Thursday, it's going to hit the House, and they'll deal with it at that time.
Right. So we have what's interesting too with this bear market now is obviously everyone compares it to previous bear markets, and so just going through past data here, in the Great Depression, the crash was an 83% loss. The duration was 2,000 days, and it took 24 years for a full recovery. In 1973-74, the loss was 35%. The duration was 700 days, and the recovery took 7 years. 1987, 35%. The duration was 61 days. So it was twice as, this Corona crash was twice as fast as 87. And the recovery took 2 years. In 2000, the crash was 49%. It took 944 days, and the recovery took 7 years. In 2008 crisis, 58%. Crash duration is 485 days with a full recovery of 7 years. So this Corona crash now is 33% down. Took 28 days, and here's the $64 million question here: how long to recover? We could literally talk about this for some time. So what are you thinking there?
Well, I mean, if we look at the previous recoveries, interest rates are certainly much higher than they are today. And one of the sort of driving factors of investments in equities over the last several years, of course, has been the low interest rates. People looking for yield have turned to the equity markets for yield and dividends. And certainly many of the large blue chip companies are paying dividends higher than what we can get on a 10-year treasury. And currently the 10-year treasury is less than 1%. In fact, today, I think the 3-month bill went into a negative territory in the U.S. for the first time. So people will be chasing yield, and they'll go after riskier assets to get the dividend. So how long does this take? Who knows? But of course, it's being driven by the virus and the economic impact of the virus. So many people think it could be a V-shape, but I'm sort of in the camp that it's going to be a little longer than that. But really, again, it depends on the stimulus package, how long it takes to be implemented, what the people do with the money, et cetera, et cetera. So we have to get the economy back rolling, and once that happens, then we can sort of assess the damage and the length of time it's going to take to get back. But I'm sort of in the camp that we may not have seen the absolute low. We've had a couple of really good days here. We need to have continued follow through. We need the stimulus package approved on Thursday. I guess it's now, be Thursday for the House, and then we can see. But until then, and especially we need to see containment in the virus. The virus is the key thing because it's locking down states, it's locking down businesses and so forth. So we need to see economic activity reinstated at some point. And then we'll have a better idea, how long it's going to take to get out of this situation now.
So looking at it pragmatically, how does the economy rebound from this when we have 3.3, the estimates are over 3 million jobless claims will be announced tomorrow. Could be a little bit higher. And so we have the stimulus package, which will place possibly, I'm reading through it and I can't quite see, I think it's $1,200 per person and $500 per child in the United States. And I believe it's one time. How does that possibly offset the economic hardship that they're enduring? And so depending on how long that's one question. Two, depending on how long COVID crisis lasts and how long the economy is literally shut down, do people just come back and begin spending again? I have a hard time believing that. I think the discretionary purchases will be largely absent, and it'll be food, rent, fuel, mortgage.
Well, I think you're right. I think one of the whole reasons for the stimulus package, of course, is so that people don't end up in debt too much. Now, again, the $1,200 and $500 per child is based on your income. So taxpayers making less than $75,000, for example, receive the check, and married couples it's $150,000, and then $500 per child, again based on your total family income. I think that certainly will help impact the hourly worker, who is the person who's under most of the pressure. In other words, they're the one more likely to lose your job and less likely to have quite a bit of savings to carry them through there. The other thing is also, I think they're going to be a lot more flexible on the unemployment benefits, and from what I understand, and I don't know this for sure, but I think they're going to try to top up the insurance benefits. So in other words, you'll get your regular benefit plus an additional sum of money to carry you through, because obviously what you just said is exactly the worry. If you're out of work for a longer period of time and you don't have savings, first of all, the first thing that you're going to take care of is your rent and your food. And, even if you're given a deferment on your rent, when you do come back you start working again, first thing you're going to have to do is pay that deferred rent or the deferred mortgage. So I'm sort of with you. I think this may be a little slower recovery than people think. Instead of being a V, I think it's going to be more like a U. But again, it just depends on how they implement these aid packages and how long they last.
Right. So looking at
the first aid package, $2 trillion is very attractive, but they may have to assess it in another couple of months if this virus continues.
Right. Well, $2 trillion represents nearly probably 40% of the total spending for the fiscal year for the United States. So as we know, they've been printing quite a bit of money and going deeper in debt. So this does not help whatsoever. I mean, it's necessary, and maybe this is our next topic in terms of how necessary. However, I think the market is probably pricing in, with this recovery the last 2 days, so I'm looking at the volume, it's not quite high. It doesn't have that volume to really make me feel better about, this 2-day rally is meaningful or not. And looking at, could probably see, summary of these past crashes, the average duration was 2 months to 3 years. And the average recovery was between 2 and 7 years, and the average loss is between 35 and 58%. So if the market was quite overvalued prior to this, again, I'm thinking, does it have a V-shaped recovery and go back to being overvalued again? So there's quite a bit of data that still needs to be processed.
Yeah, and I think, Paul, the other thing is, in the past, if you look at the crash in 2008, 2009, you look at the tech bubble crash and so forth, those were focused primarily on one industry. In 2008, 2009 was focused on the housing industry and the construction industry, and the ripple effect of those sectors was quite impactful in the rest of the economy. The tech bubble was the same thing, and again, it was focused in the tech industry, but it had a ripple effect through the economy. What we're talking about today is much different than those two recessions. This is a complete economic shutdown, stopping economic activity. So I think this one is the implications are far greater than what we've seen in the past. And again, it goes back to, I guess you and I are both on the same page, more of a U-shaped, an extended U-shaped recovery versus a V-shaped recovery.
Right.
Yeah.
Well, given how different this is, as you point out, it makes sense now that large in 2008 was a bailout of Wall Street, whereas this bailout or this aid package is Main Street as well, with directly placing money in individuals' hands. So that is very good to see, much needed. And I guess my only question is, will it be enough? And we only know that depending on how long the crisis continues. So let's move on to
time will tell.
Exactly. Next slide here. So pretty controversial. We have Trump saying we can't let the cure be worse than the problem itself. At the end of the 15-day period, we'll make a decision as to which way we want to go. And you and I were talking about this. Was he getting information from a Californian epidemiologist, or who was it?
There's some, I'm not sure exactly who it was, but I think it was in the LA Times this past weekend where I think it was a chemist or somebody who came out who is involved in this in some way, made that quote, and I think he's referring to that. And he's not the only one that said it. I think someone what was it, the Israeli defense minister, somebody came out and made a comment regarding we should be quarantining those who are the most affected or impacted, and those are with pre-existing conditions and people over a certain age, and we should quarantine them. And I'm sort of in that camp where I think shutting down all economic activity for the sake of, people who have pre-existing conditions and people of senior age, and I'm one of those senior age and have a pre-existing condition, I feel that, and let's say if you were to quarantine everybody over 65, for example, most of those people would be retired. They're receiving pensions. They're not, they're not in the workforce. Those that are in the workforce, if you were to say to them, okay, we're going to, provide you with a level of income or something to maintain, your rent, your food, and so forth and so on, I think the aid package could be much, much less. And also those with any kind of a pre-existing condition, you want to certainly quarantine them because, of course, they're the ones that are most susceptible to this infection and possibly death. And let the rest of the economy continue working. But that's not what's been done. We've actually, I guess we've taken the politically correct view and decided that we'd shut everything down. And I think that the damage could be far worse than what it could have been if we had properly managed this situation. And but that's my 2 cents on it. And again, it's sort of Monday morning quarterbacking, but we're still in the midst of this problem and this issue, and the cases still seem to be rising. The deaths are still increasing, and if you look at the stats and you look at the statistics, those most affected are pre-existing people with pre-existing conditions, as well as the older generation, and we need to protect them, and we need to protect the rest of society. And I think the only way to do that is to quarantine, as I say, the seniors and the people with pre-existing conditions. And that means that some people with pre-existing conditions can be, younger age, considerably younger age, but we need to protect them as well. But anyway, that's sort of how I view the situation.
Yeah, that's what the Israeli defense minister raised, I think, 2 days ago, and it certainly seems logical. And I think caught ahead of time, that would have been obviously the preferred route. And I just wonder if now that the cases are spreading quite quickly, if that still would work. And hence we have Andrew Cuomo's tweet here in terms of this seems very, very politically correct in terms of talking about, and we're not saying his mother's not expendable. No one's mother is, no one's father is, no one's family member is. However, it's kind of making it seem that we're putting, or putting dollars ahead of lives. And certainly with what you just described would have been a very good way to handle this. However, we'll see going forward if that will be done, because I think you can't have the economy shut down on a week-to-week basis, wondering when you're going to open. They're going to have individuals that start revolting, like literally, I'm going and you can't tell me. Hairdressers will start taking clients in their home, or auto mechanics will start having clients coming in. I just can't see people sitting around waiting for this to open. Just on the figures, Bank of America said unemployment could be 12%. Morgan Stanley had 30%. JP Morgan, I think, was 15%. And Goldman was in the 25% camp. And then James Bueller, the St. Louis Fed governor, said 30% unemployment and a 50% hit to Q2 GDP. That's massive, Warren. That is a massive hit in Q2.
I know, Paul, and that's what worries me the most is, one, we're adding on to our debt with this aid package, and our debt was unsustainable in the first place. And two, the impact, if you think about most people, I look at it very simply. Most people are happy if they have a job and they put a roof over their head and they can take care of their family, and, they can go on a vacation every year, right? And life is good, and they can buy some toys, so to speak. You take that away from them, and as you say, you're going to get people that are going to be violating the lockdowns, and it's going to spread, potentially increase the spread. It's going to be more fatal, I believe. So that's why my belief is you take the people most affected, you deal with them, take care of them, separate them from the rest of the herd, so to speak, and let the herd keep on foraging and working and keeping the economy going. And whereas, if you have 30% unemployment, that's depression era stuff. That's a situation that no one wants to see. But based on how they're handling it right now, that's what I see in the cards is extreme unemployment if this thing continues for any length of time. And then it morphs into a debt crisis, in my view, because I think we were already faced with a debt crisis. This is just compounding this situation. So it all around, it just does not paint a great picture. So we just hope that, warm weather brings a reduction in, like the common cold and flu, that it also impacts the virus in the same way. And we come into spring and it just sort of dissipates, and the number of cases start falling, and the number of deaths, of course, start falling, and so forth. So, yeah, it's just not pleasant when you think about it. It's quite ugly.
I recall Ben Bernanke, the Fed chairman during the financial crisis 2008, and he said that he was a student of the Great Depression, and one of the takeaways was the Fed didn't act aggressively enough and didn't turn on the liquidity fast enough. And so he obviously did that in 2008, and I think current Fed Chairman Jerome Powell is also doing it in a massive way and very, very quickly. And so it's going to be highly inflationary. Again, given what's happening in terms of shutting down the economy, it's needed. I guess we're talking in circles here. It's just unfortunate that it came to this. So let's move on here. So here we have, this is driving the markets. This is why we're showing this chart. And we have North America, the US and Canada doubling between every 2.5 to 3 days now. And see China, where's China here? Can't see it, but it's just from memory here. I think the crisis largely over, and that was to a very, very quick and effective intervention. They locked down everything, and there's very, very strict measures in place. And we've been tracking the data as well for Canada and the US individually. And you can see how in the first date, January 23rd, it took roughly 7 weeks to reach 93 cases roughly in 7 weeks. And then in a matter of 2 weeks, from March 11th until today, 2-week period, we have almost 2,000 cases in Canada and ballooning to 55,000 in the United States. And when we overlay this with the stock markets, we can see there's a negative correlation between the number of cases increasing and then the performance on the stock market. So it's the S&P 500 in Canada as well. So it all looks virtually identical. And so the hypothesis here, really not hard to see, is that the markets are kind of being driven by this COVID-19 cases. So we're looking for the inflection point where the rise in new cases starts to slow. And I think that's where I think we can feel a lot more comfortable that, okay, now the market's not sort of driven by it, and it'll be more of the underlying company fundamentals.
Well, one of the positive note on this, Paul, is that, the market typically, historically anyway, anticipates about 6 months out. And, given the fact that the stimulus package has come, the Fed has done their thing by dropping interest rates and providing liquidity into the system. We're now looking at the fiscal packages that are coming out and being implemented. The market may be anticipating that within 6 months, this thing could be behind us and we could, starting back to full employment and so forth. And as a result, we see a little bit of strength in the market. I don't know what it would take, but it may not take a whole lot for it to reverse and reach a lower low. But I think the good news is that we've had a couple of strong days back to back, and hopefully we can continue the week with some at least positive numbers. That would be very encouraging, and I think at least change the mindset of a lot of people of all the doom and gloom that we have out there. And we've talked about a lot of it here in this call this evening. But the bright spot is if we anticipate 6 months from now that things will improve, and that means equity markets could be poised to continue the 2-day rally into maybe 3 days, and maybe the volume increases a little bit as we go along.
Right. Well, in terms of a market bottom, we all know we can't time it perfectly. We'll never know when it's there. I do know from experience when the news is at its worst is likely you're near bottom. And so I don't think we've had the worst of the news. So just based on that, I don't think we're there yet. And, just based on past crashes, it's just been far too soon. We'll likely have, a rebound. It's almost a bull trap where we could go up another maybe 5% and then, break the recent lows. And then if you look at the S&P, historically there's support around 1,700, 1,750 or so. Possibly that could be maybe a territory where the markets could sort of have that U-shaped recovery. And we need to see what the effect is of the economy, what the Q2 GDP numbers are, how long will businesses be shut down. So I think there's too many unanswered questions to really feel comfortable about calling the bottom. However, saying that, we can still average in. So in taking 1/5 of your capital and start buying certainly at these levels, it's not a bad idea whatsoever. Any comments there?
No, I agree. I think that, if you look at just 2008, 2009, I use that as an example. And again, that was a housing crisis. It wasn't, economic shutdown, economic activity shutdown like we have today. The market declined, 53, 54%. And if you were to take that basis on the Dow, for example, and look and say we're around 3,000 or 30,000, that would take us down to 15,000 on the Dow, and the Dow is trading around 21, 22,000, I guess. Yesterday, I guess it was 21, but that means we would have a little further to go on the bottom to actually hit that bottom 50%. Now, I'm not suggesting that will happen, but certainly I think that's in the realm of possibility, and of course, time will tell. But when you see valuations of companies as low as they are right now, some really good companies are not being impacted as much. And in fact, it wasn't, I guess it was last week we saw an all-time, and I haven't seen it this week, Walmart hit an all-time high, for example. And there are other companies out there like Walmart who have actually held up incredibly well during this crisis. So, I think, as you say, it's, nibbling in at this point is probably not a bad idea with, 20% of your cash if you have cash, and being very strategic with your investment decisions right now, I think would be critical if you're going to enter the market. But it can be done, and certainly does look attractive with some of these stocks.
It's amazing how, looking at, actually, have we discussed GDP? Yeah, I mean, obviously going to be taking impact in Q2, and I think, so if St. Louis Fed is correct at 50%, and then you can see Q3 probably, lower than that, and then Q4 probably lower than Q2. So, lower meaning, better. So again, this year could be just one of those years where it's just, it wasn't expected. This obviously wasn't expected, and investors just have to ride it out, and with a longer term time horizon and buying some quality companies, they could, come out of this okay. But again, having a 3 to 5 year time horizon and buying in this market. When you look at the volatility, it's interesting how prior to this, I think the rule of thumb is volatility, the VIX, anything over 40 is just, you can't invest in the market. It's too volatile. Yet we've consistently been above 40, I think, for now 2 weeks in a row, or possibly been 3. I have to check the charts. And people just adjusting to this new normal. And it's astounding to me. How long do you expect it to continue?
Well, who knows? As long as we continue having news on the virus, and I think that's the underlying cause of the underlying volatility, there are also sort of exogenous events that are taking place as well, and we certainly have seen those that have impacted the volatility as well. Just this past week, the market rallied on the idea of an aid package, a $2 trillion aid package in the U.S., and Trump saying, we got to get back to work. It was very optimistic, and right or wrong, the market responded. And we're seeing, day by day, certain news events coming out influencing the market and creating more volatility. So the underlying volatility being caused by the virus, then you have these news events that impact the volatility and increase a little more volatility. And don't forget, I think this volatility could go through a little longer than people think. And one of the main reasons is, we still have a nomination, Democratic nomination for president coming up. The convention is in July, I think July the 11th or 12th. And then, of course, we have the election. And if we use the last election as any indication in the U.S., there was a lot of volatility around that election. And, of course, this one is very contentious as well. This election is going to be very contentious. And so I would expect that, maybe we see volatility subside a little bit with good news from the virus containment, if there is, when it does occur. But then there's going to be other events that are going to cause an increased volatility as well. So, I think this year is going to be a pretty rocky year, and it's going to continue. I'm just hoping that between now and July, and between July and November, that we can have some periods of calmness in the market, and the volatility will decline slightly.
Yeah, we've discussed businesses reaching the breaking point. Actually, just going back to conversations I've had with some clients and colleagues in the industry, the banks have been quite accommodative in terms of stepping up and having an appreciation for the situation, being able to work with their clients. So that is great to hear. Have you heard similar stories?
Yeah, I think there's going to be similar stories. Also, there's a lot of private debt funds that are looking at this as a wonderful opportunity to increase their book. And again, we're going to have these aid packages, these fiscal packages being brought forward. They're going to provide loans for small businesses to help them stay afloat during this difficult time. And so it's all good news in that regard. It's going to be difficult, yes. It's not going to be easy, but at least there are programs that are going to be in place. They're going to assist these small businesses. And don't forget, Paul, 70% of the employment growth and business activity comes from the small businesses. They're the real engine that drives the economy. It's not the big multinational companies. Yes, they employ a lot of people, but they typically don't add tremendous amount of jobs. If they add a couple thousand jobs in a year, that's just phenomenal. Whereas the engine of growth is always the small businessmen. So we need to take care of them so they can continue their business and grow their business, and also businesses that want to start up. So with accommodative fiscal monetary policies, that should help that situation.
Yeah, exactly. Small business is the driver of the economy, and the consumer is 80% of GDP. So with these aid packages, with some money hitting their bank accounts, much needed. So that's very good to see compared to what happened in 2008. And speaking of 2008, I'm just currently reading now, airlines are looking for a bailout. And have you heard anything in terms of, will it be similar package where the government would take a equity stake in the businesses, and then when their revenues return and stocks start to rise, then they can sell and hopefully make a profit out of this? Have you heard anything like that?
Well, yeah, I've heard a little bit about that. And also, one of the things, I think the aid package will be handled much differently than they were in the past. There's been rumors, and I haven't seen the actual details yet, that if you're a business and you're receiving a loan, there's going to be restrictions regarding compensation packages to executives, stock buybacks, which has been, as you well know, Paul, it's been a key driver to this market over the last several years, corporate stock buybacks. And they're not going to be able to buy their own stock. There's going to be a limitation as to when and they can reestablish those buyback programs. So I think this is going to be handled a little differently than the last time. And I think it's all positive. So it's nice to see they're going to put some restrictions on some of this, because remember the bailout in 2008, 2009, and, within, a very short period of time, there was news of big bonuses being paid to these money center banks, or these large banks and investment banks, and, they were bailed out by the taxpayer. And it just didn't sit well, and especially using taxpayers' dollars to bail them out. So this time, I think it's going to be handled a little better, a little smarter than it was the last time. So I'm optimistic that it'll go down a lot easier. Let's put it that way.
Mm-hmm. Okay, well, we should wrap up soon here, not to take too much time. Obviously, with this trillions of dollars and billions in Canada, we have, QE to infinity narrative again, and throwing money out of helicopters, adding to the debt, which is already, I think it was over 100% of GDP as it stands. So just when I think we're trying to get ahead, it's hit back with another setback here. And with the Fed now and Bank of Canada having rates near zero, do we see a negative interest rate policy now in the United States, where before I think it was unthinkable or a very low probability? And I discussed this in Europe. It's currently been the case, and it hasn't really stimulated their other economies.
No, it hasn't. And, I think if we go back a couple of weeks when the Fed, in the beginning of this crisis, the Fed dropped their interest rate by 50 basis points, and the market responded the next day with quite a significant negative drop. And then we saw the zero interest rate policy being announced a week ago, and we saw the very next day the largest single down day in the history of the stock market, or at least matching previous, years and years ago, decades ago. I think monetary policy really is not as effective as it once was. And at zero, it doesn't really matter. If you're Joe Lunchbox and you're trying to make ends meet, you really don't care if interest rates are zero. You're not going to be running out and buying a new car or a new truck or whatever. You're really trying to put food on the table. And, mortgage rates are so low now, it means little. So I don't think it's as effective as it once was. But the level of debt is certainly important. As you say, it's 100% of GDP. This is just going to add to it, and it's going to be more difficult to repay this debt, especially if we don't have any economic activity. So, this compounding of the debt again, I think is not a good thing, but certainly in this situation is definitely necessary, and why we should have some of these fiscal programs. We definitely need them.
Well, it just seems that the Fed is just trying to avoid at all costs a normal business cycle. A normal economic cycle, and it's growth all the time. Where in the past it's been there's a lot less intervention, and there's booms, busts, expansions, peaks, troughs, etc. Now it's just 100% growth all the time, and there is consequences to that. That's possibly
I think you're right. I think what I was going to say, sorry for interrupting, was, what's really happened is the Fed has been politicized. And because who does it help? It really makes the politicians look good that they can tell their voters that, hey, we haven't had a recession, or everybody's, fully employed all the time. But at the end of the day, we need to have these recessions. We need to have a culling of the herd, so to speak. And, we need businesses that are not efficient and not, running on a profitable basis. We need to see them go. We need to see them, sort of fall to the wayside. It's a good thing. It's just like, the seasons of nature. We have spring, we have summer, fall, and then we have winter. And then, we have a new spring again. And we need the same thing in the business cycle. And the Fed has basically tried to repeal that. And I think what it's caused is asset bubbles, tremendous asset bubbles. We had one in housing. Now we have one in stocks. And it's very painful when you go through this. Very painful.
And these bubbles pop. And you cannot indefinitely blow a bubble. Alan Greenspan's famous for saying is that bubbles are only perceptible after the fact. When you're in it, you don't know you're in it. And so we can go on and on about this. So maybe let's wrap this up. Any closing thoughts until our next conversation?
Well, I guess not really, in the sense that, we're being dictated to by the virus, and no one really knows how long or how deep this virus is going to go. And we just have to take it day by day. And I guess, and take our lessons from history and try to apply them to this situation, and be patient and wait for it. We will recover. This isn't the end of the world, but it certainly feels like it when you're going through it. But we will recover, and things will be better on the other side. And again, we didn't mention this earlier, but typically when you come out of these crisis periods, the first year or so is in the equity markets, a very, very strong year. And if your time horizon is 3 years, you should have, find very attractive returns in equities once again. So I think everybody just has to be patient, take this with a grain of salt, that this is a difficult period, but we will get through this and we will prevail. And we'll come out on the other side, I think, quite stronger with we'll have, certainly medical community will be in better shape because they'll be more prepared if we have another pandemic of this nature.
Mm-hmm. Yeah, I think I'll add is, I think in terms of searching for a bottom, no one will ever find it. Average in, I think the market will be looking for a peak in cases and the growth rate to stop. And just focus on quality companies. The market, as Buffett says, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. And so it's very emotional now. And you have companies that are, some companies are being priced at less than book value, and the yields of now are quite attractive. And there's some fantastic opportunities. So thinking like a business owner, and in a crisis, there's also opportunity. So it's not bury your head in the sand and do nothing about this. So it's so there's lots of ideas out there still. So I encourage listeners to call your advisor if you have any questions, like to speak with your portfolio. And for those who are not clients of Sightline, feel free to reach out and have a conversation. Thank you, and until next time. Thank you, Warren.
Yep. Thank you, Paul. Good night.
Okay. Good night.